Hi, good morning, everyone. Thanks for joining our 11:15 Phillip Security Research morning call this week. Today, we'll be covering a few technical analysis as well as a recap on the fourth quarter 2022 Singapore strategy. So with that, I would like to hand over the time to Zain to discuss on the technical analysis portion.
Thanks, Sean. I'll begin with the review of the STI last week. So last week for the STI, we tagged onto the key uptrend support line that has been supporting the index since the lows of March 2020. And the immediate support zone is currently at about the 3070 to 3130 zone. And as for the immediate resistance wise, is likely to be at the 3200 to 3220 zone, which is the 50 to 61.8% Fibonacci retracement levels using the September swing high to the October swing low. And this is also confirmed with the previous swing low back in September near the 3200 level that we broke down off, and also the Ichimoku cloud resistance at 3200. Next slide, please. For S&P 500, we are currently in this downtrend channel. Last week after we bounced from the bottom of the channel to the top, we formed an island reversal pattern with the bearish candle on Friday. So with that, the immediate support will likely be at September to October 2020 previous resistance level, and also the 200% extension area at about 3480 to 3600 zone, and we can also see support at about 3500, which is the 50% important 50% Fibonacci retracement level when we use the March 2020 swing low to the all-time highs for the S&P. As for the immediate resistance level, is likely to be at the 3700 to 3800 zone, which is the channel resistance, and then the resistance from last week also. Next slide. So for individual stocks wise, we have three of them. The first one is the Alibaba. So for this stock, we have a technical buy at $80.45. The TP is at $90.50. Stop loss can be placed at $76, and the stock last close at $81.24 on Friday. So for Alibaba, there's a potential bullish reversal to the upside, given the formation of a bullish hammer candlestick on 3rd October and a confluence of a double bottom and a bullish falling wedge support level of $78. Also, the RSI technical indicator is displaying increasing momentum, while the stock consolidated at the double bottom support area, which points towards a bullish upside. With that, the price could reach the resistance level at $90.50, which is confluent of the 50% Fibonacci retracement level resistance when we use a swing high of $104.85 and $76.28 as points of reference. Next slide. So the next stock will be a Lucid Group. So for Lucid, we have a technical buy at $15.40, the TP at $17.65. The stop loss can be placed at $13.50, and the stop loss closed at $13.17. So with that, our stop loss was being triggered, so this trade was being invalidated. Last week, we saw there was a potential bullish reversal to upside after it broke out of the downtrend. Given that there was a formation of a bullish Morningstar candlestick pattern on 4th October at the double bottom support level of 1350, and then the MACD technical indicator was displaying increasing momentum, where the MACD line made a bullish crossover over the signal line. The price could reach the resistance level at $17.65, which is confluence of the 50% Fibonacci retracement level resistance, using the swing high of $21.78 and $13.52 as points of reference. So moving on to the last stock will be C Limited. With this, it's a technical buy at $60.50, the TP at $73. Stop loss can be placed at $53.30. while the stock does close at $60.05 on Friday. So for C, there's a potential bullish reversal to the upside to retest this key downtrend resistance line. The formation of a bullish hammer candle on 5th October at a support of $57 while it broke out of the 20-day moving average concurrently points towards a bullish upside. And the MACD, the technical indicator, is displaying increasing momentum as well. With that, the price could reach the resistance level at $73, which is the confluence of the downtrend resistance line and also a 50% Fibonacci retracement level resistance. And we use a swing high of 93.70 and 52.38 as per points of reference. So with that, that's all for my the technical analysis section. I'll now pass on the time to Paul and the rest of my team to give a summary of our fourth quarter equity strategy that was discussed in the Singapore strategy and stock picks last Saturday.
Yeah, thanks, Zin. So we're just going to give a summary of our fourth quarter strategy, which was titled Hibernating for Winter. So sorry for those who've already attended the full session, but we usually follow up with a summary. So in terms of the macro, very quickly, just in terms of the macro framework that we're working on in terms of the fourth quarter. So the first theme is basically don't fight the economy. So what we're referring to is basically based on the yield curve. We are looking at a high possibility of a recession in 6 to 12 months time, which the bond market is already pricing. Just to give clarity on this chart, so this is the yield curve, which is the difference between the 10-year and the 2-year yield rate. So typically, it's always positive. So the 10-year bond, or we always like to say, let's say a 10-year fixed deposit should always yield higher than a 2-year fixed deposit or a 2-year bond yield. So it's always above zero. But whenever it turns negative, it has a very good predictor. There's no causality here, but it just at least a very good and consistent predictor of recessions. So the last time we had, excluding the pandemic, was in 2005, where it inverted. That means it went negative before the recession, which is in the beige bar. Next slide. So how it impacts the Singapore STI. So when we looked at the past 4 recessions, in the month of the recession, of course, the tricky bit is when is the month. You won't know it until the NBER kind of announces, but there will be a bit like months away. But assuming there's a recession, on the month of let's say on the month of the recession, the index is 100. You can see that typically once we enter a recession, the market can drop 20%. But again, it doesn't mean every recession is the same. What it does mean is just that it will impact the Singapore market. Without stating the obvious, but if you add in all the numbers, this is how it typically looks. Every recession is different. Some may be only down 10. Some may actually doesn't even drop. It might actually climb 4-5%. But on average, there is an impact to the STI if the US enters into a recession. Next slide. So the next theme we were talking about, we just don't fight the Fed. I guess it's a very common phrase, but one of the reasons is because we expect more rate hikes to come. It could peak. We're just going to, our base case is basically just follow what the futures market is pricing in. So the peak could come in maybe February or March. So you should expect another 150 basis points of rate hikes until the first quarter of next year. And one of the reasons, of course, is why the Fed needs to hike now, and this is the best time now since employment is strong, is because number one, they are very worried of inflation expectations. And what it means is that if inflation continues to linger very long, then workers will demand higher wages because they think inflation is going to climb higher. Households will want to consume, will try to consume or even hoard or speed up their consumption because they assume inflation. So the longer inflation stays, then it might actually lead to even more inflation. And the second reason is also, the Fed realizes that if they take on the rate hikes earlier, then maybe in the later part, they don't have to hike even higher if inflation comes in stickier than expected. So imagine, if you pause now, then you wait 6-12 months and inflation continues to climb, then you might have to raise interest rates even higher. So they just want to preempt that. These are some of the rationale why they need to move so aggressively now. Next slide. Of course, the other thing to note of is that the end of the magnificent bull market in US Treasuries, magnificent because of the size. The US Treasury is more than a 20 trillion market. The second thing is, if you're buying fixed income, the last 40 years, it gives you the best Sharpe ratio, which is the best return in terms of measured on volatility. That means best return on the lowest volatility, which was the fixed income. And of course, you can even leverage on top of the fixed income. But no, that whole area is at risk now because we could be coming to the end of a 40-year bull market in bonds or low interest rates or falling interest rates. The issue is also that any back test you do now on any asset class is going to be different. I mean, maybe REITs might have done well. Again, we're not sure, but that was in the era of very low interest rates. And so any back test that you do on any asset class would look different now because we're entering into a new era of higher interest rates. Next. So the third theme is now don't fight inflation, I guess. So what we're just trying to say is that inflation headline is likely going to come off. So next week, we're going to get the US inflation number. We think it's going to come off, which is the red line. Because if you look at the blue line, there's a very high correlation. Since commodity prices have come off quite sharply, we should expect the red line to also drop. But the problem is that commodity prices are extremely low, and you've seen how oil prices can rebound. So again, that is the one of the worries that we have the volatility in commodity price. Next slide. I think we showed this before, Mami, just to say that services is the one that continues to be sticky, and it's also driven by the strong employment numbers. I think although there's inflation, but if income levels are high and employment is full, then the demand will still be strong for services. So services here include namely shelter, which is rent, used cars, airline traffic, and airlines, and so forth. Next slide. The other thing to note of is that the Fed still has a lot more work to do, because their target is the red line too, and right now it is green. Right now it's about 4 point something, which is the blue line. If you look at the numbers, the real jump in inflation core probably came in probably February or early this year. So the only chance where this thing can also come down on a year-on-year basis, because you got such a strong spike, is probably early next year. So early next year, based on the higher base effect, right? Because early this year the jump was so strong. So when you compare it to year-on-year, you might get a better number, at least year-on-year. So early next year is probably when you could see a more meaningful drop in this blue line, which is the Fed's core main inflation measure. Next slide. So the fourth theme is we think Singapore can fight off the recession coming up the US. So, one of the thing is that there's very strong domestic consumption. Of course, one measure is retail sales, but if you just look at the GST collected in Singapore, you can see that this is the absolute amount. This is the rolling 12 months, so it's about 13 billion Sing. It used to grow about 1% pre-pandemic, but right now it has jumped about 16%. So even though you can take into account now it's reopening, but again, the amount of domestic consumption is exceptionally strong. And some of the reasons why is the growth is driven by, next slide. Of course, there's ample jobs, there's record. If you look at the red line, in terms of the vacancies for managerial level, they're talking about 50,000-60,000 vacancies. The ratio to unemployed is the highest since the 1996, during the boom times of 1990s. Next slide. Of course, there's also wage growth. This is wage based on the CPF contribution. So that is also growing very strongly, probably the best in the decade. Next slide. Of course, the population, last year we did discuss. So in 2022, the amount of residents coming in, this is the resident population, is 86,000. This is equivalent to almost 3 years of resident population all coming in to Singapore in just 1 year. Of course, some are conversions or whatever, but just using it in a very broad sense. Next slide. Then of course, we have tourism returning with record room rates in Singapore. Next slide. Valuation-wise is, of course, at the lower quartile, so it is cheap. I mean, one way to gauge this is that whenever it goes below the orange line or the low line, then it tends to bounce. or yeah, at least it means that there will be a valuation expansion. Next slide. But of course, you have to measure, like we mentioned earlier on, we are in an era of high interest rates. So what it does mean that even if you take into account the rising interest rates, the valuations are about fair, because this is the current 10-year yield. So you have to, we didn't price in, maybe the yield might move a bit more higher since there's rising, the Fed's going to raise. But you can say that even taking into account higher interest rates, the PE ratio, which is the earnings yield, which is the opposite of PE ratio. So what it means is that if PE is 10 times, then the earnings yield is 10%. That means if you buy a stock right now, you're collecting like 10% return, not dividends, and then you minus off the 10-year bond yield, you get the so just one way to take into account the PE ratios considering the higher interest rate environment that we are in right now. Next slide. Okay, I'll hand it over to Zain on the technicals, but I think he'll skip the STI. Yeah, okay. Zain, over to you.
Thanks, Paul. So for our top large cap pick, it will be DBS. So for that, it has been in up 5-wave uptrend pattern since July this year, and it's currently moving inside this uptrend channel. And it has also found a support lately at 3180 to 3250 region. And we use Elliott wave projections. The wave 5 projected target is likely to be at $35.93, which represents an upside of over 7% from the current price. And this upside target is also confirmed with the midterm trendline resistance, and also the possible double top resistance at the main resistance area of 35 to 36.30. So next slide. So for our top mid-cap pick, it will be Geo Energy Resources. It's a coal mining group with production operations in Indonesia. After the stock made a double top at the 48 cents to 50 cents region back in March to April this year, it has since pulled back to the support zone at 33 cents to 37 cents. And we see there's a possible bullish up cup and handle formation that's in the making, where the neckline resistance is at 42 cents. Measuring the low of the cup at 33 cents to the neckline at 42 cents, this gives a length of 9 cents and a projected target of 49 to 49.5 cents, about an upside of 28% when we measure against the possible breakout point at 40 cents or 40.5 cents. The upside target is also confirmed with the double top resistance form at 48 cents to 50 cents earlier this year. So that's all from the technical part. I'll pass on my time to Glenn to talk about the banking sector trends.
Thanks, Dean. So for banking, the first slide will be just a brief recap on the bank's second quarter results. So the second quarter results, the bank's net interest income rose 17% year-on-year, as their net interest margin improved by 8%, and this is backed by loans growth of 8% as well. However, their fee income was a drag across the board, and it declined 10%. But this still resulted in PATMI growth of 15% year-on-year. If you can see from this chart here, you can see that we expect the 2022 full year PATMI to be quite significantly higher than 2021. And we also expect that the dividends, which is the red bar, to rise in 2022, but it will start to taper off in 2023. However, we expect that the PATMI will continue to increase in 2023. So the NIM will be exiting at a high at the end of 2022, and this will carry forward into the first half of 2023, but we might see a slowdown in the second half of 2023. So for the next slide, this is a slide of the average NIMs across the three banks against the benchmark rates, which are the 3-month SIBOR and the 3-month SORA. So how do the banks earn from a higher interest rate? So they actually earn from the spread in the interest rates. So when the rates go up, they can earn more from the money that they invest, but yet maintain the same amount paid to their customers. And this extra income goes directly into the bank's net interest margins and net interest incomes. And we can see this reflected in the results. So we can see that the NIMs track the benchmark rates quite closely. And with the
NIMs, with the interest rates only going up and expected to go higher, we will see that the NIMs will follow suit and increase accordingly. However, there's a worry that with the higher interest rates, the loans growth might be slightly slower. And this is seen with the banks lowering their guidance across the board from high single digit to mid single digit growth. And while the Singapore loans growth will be slower, we could see higher loans growth in the rest of ASEAN as the economy reopens and recovers from the lockdowns, especially in economies such as Malaysia, Indonesia, and Thailand. And as such, we maintain overweight on the banking sector and remain positive on the banks. The bank dividend yields are also attractive with upside surprises due to excess capital ratios. And the stable economic conditions in ASEAN and rising interest rates remain tailwinds for the banking sector. So that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. So here's our outlook on the REITs. So looking at this graph, this is the S-REIT yield spread over the 10-year Singapore government bond yield. The S-REIT index. So as you can see, right now it's trading near the -1 standard deviation levels, or actually even under. So which means that the investors are not really paid, like not really compensated for the additional risk that's going on right now as compared to last time pre-COVID, as like around 2015 level, you see is trading above the 1 standard deviation level. So right now we are underweight on the REITs, mainly because of 4 reasons. One is because of the rising interest rates. That's going to affect the DPU payouts as you need to pay more interest. Second is because of the rising discount factor. Your investment property will be affected also the value. And third is because of this yield spread. Like right now, because the yield spread is only 1 to 2%, like you can think of it as fixed deposit is paying you 3%. What for would I want to invest in a REIT that's paying 4 to 5% when back then is paying way more than the fixed deposit rate? And the last one is because of the rising cost of borrowing as well. It's very hard for inorganic growth, like acquisitions, because the cap rate minus the cost of acquisition is narrowing as well. Yeah, next. Yeah, so just now that graph was for the REIT index. So this is more in detail into some of the Singapore REITs. And yeah, so as you can see, the red box pre-COVID and now is trading around the same levels as compared to that's the local REITs. But for the overseas REITs like Prime US, you can see that the dividend yield spread over the 10-year Singapore government bond yield has really shot up, which means that Prime has actually priced in all the risk, but the local REITs hasn't seemed to price in any of the risk yet going forward. That's why we think that there might be another sell down in the local REITs. Next. Yeah, so this is the scatter chart for some of the valuations. On the x-axis, you can see is the dividend yield. Y-axis is the price to book. So how to read this chart is towards the top left-hand side is a more expensive valuations and less dividend yield, which is more expensive for the REIT. And on the bottom right is actually cheaper as they are paying higher dividend yield and they are trading below their book value. So as you can see in the chart, the local REITs, a lot of them are trading around the 4 to 7% dividend yield and around 0.8 to 1.4 times book value. While the overseas REITs, they seem to have priced in the risk. As you can see, some of the REITs are trading at over 13%, and they're all trading at about 30% discount to their book value. Yeah, next. Yeah, so this is a chart on some of the local REITs, sensitivity analysis on them of a 2% rise in interest rates. So the blue one is the hedged impact. Because they are hedged, a lot of the REITs are hedged about 70% to 85%. So the orange line is just in theory, if they are not hedged at all, that would be the impact to the DPU for a rise in 2% interest rates. Next. Yeah, so this is the carry, as we call it, like the cap rate minus the cost of borrowing. Like before, we can see that the carry is around 3 to about 5-ish%. But going forward, because of the rising interest rates, the carry we think will narrow to about 1 to 3%, or it might even go negative in some situations. Yeah, so that's all for me on the REITs. I think I'll hand over to Terence right now.
Thanks, Darren, and good morning, everyone. For the air transport sector, we see a steady recovery. If you look at the table here below, the relaxation of border measures has seen a recovery in air traffic to Singapore, and we expect the September F1 and some of the neighboring countries' borders relaxation like Japan, Hong Kong, and Taiwan to provide a boost. However, we still see some near-term headwinds. The latest numbers from August is still at 40% of pre-COVID levels, and China remains closed at this moment. So China used to account for about 20 to 25% of air traffic numbers to Singapore pre-COVID. So as long as it remains closed, along with the higher expenditure already incurred for to account for the reopening, there's still some near-term headwinds for the sector. So at this moment, we remain neutral on the sector. In our next slide, on the construction sector, the contracts awarded has slowed for the whole of 2022. But the one bright spot is that progress payments continue to remain healthy. So if you look at the table on your left-hand side, the chart here on your left-hand side rather, it's not so clear now from the graph, but the growth, the contracts awarded is the blue line here, and you can see a dip in 2022 versus 2021. This is down 11% for first half, and in third quarter, this further decelerated to 12% year on year. There are two reasons for this, for the decline. The first is the speed, the surge in the speed of accidents, workplace accidents at the site. And the second reason is the number of dengue cases there. So what has happened is that the Ministry of Manpower, MOM, has started to clamp down on all these incidents, and what they're trying to do now is to really reduce the number of incidents at these sites. So all of these things have a profound impact on the progress of construction, and that's why you can see the contracts awarded really slowing down. But what happened is we spoke to the management of the construction companies. They say they've taken hit from the government, and they're actively trying to put in place some of the measures that they suggested. And so we think that they can put this behind them and turn around as well. If you look at the chart table here on your right hand side, you can see construction demand continues to remain robust. For 2022 to 2025, BCA continues to guide for $27 to $32 billion in construction demand. This will be driven by the rise in the number of HDB flats that HDB will be releasing to the public to cope with the demand. So overall, while there are some near-term headwinds, we believe that they will be able to put this behind them. So we still have a rating of overweight on the sector. Yeah, next slide on the utility sector. The utility sector continue to benefit from higher spark spreads. So spark spreads, to calculate spark spreads, you take the USEP or the uniform electricity prices. This is the electricity prices that retail consumers pay, and then you deduct the HSFO or the high sulfur fuel oil prices. So why we use HSFO? Because HSFO is like the proxy for the cost of electricity. So when you take the USEP prices minus the HSFO, then you get the spark spreads. So since if you look at the chart here below, since the third and fourth quarter of 2021, last year, the spark spreads have actually surged on the back of the surge in energy prices globally. And the utilities companies have benefited from the higher spark spreads. So these spark spreads are all profit for the utilities companies. So even though we see a weakening in the third quarter of 2022, especially for the spark spreads, but this at 105.9 continue remains high relative to the last 3 years. And in fact, if we put this for the 5 years, it's still at a high. So the sector continues to benefit from higher spark spread, and so for that reason, we are overweight on the sector. I think that's all for me. I'll hand over the time back to Paul.
Thanks, Dan. So move on to land transport. So this is essentially a ComfortDelgro slide. So what we are seeing here is the SBS transit, the number of daily rail passengers. So what has happened is that with the reopening, we've seen at least a 50% plus jump in terms of the average daily rail passengers. So you see the number here, 1.06 million compared to 685,000 a year ago. So you should get this reflected in your upcoming third quarter results. Next slide. The other thing is property. So this is a chart of the property inventory. The blue bar is basically the number of unsold units which have they really gotten the planning permits or pending launch or so forth. So you can see that the inventory continues to decline to only 15,000, and the more important is the red line, which is the amount of inventory to sales. So on a typical year, we have almost, on average, almost 3 years of inventory in the developer's hands, ready to launch or already launched, not yet sold. But right now, you can see the red line is only probably about 1.5 or 1.4. So this means there's very little inventory out there for new launches, and it's essentially a developer's market. But it won't be good for the real estate agents because volumes have been will be coming down because of the lack of launches available. The next slide. In terms of oil and gas, there's probably two messages here. The first is there's going to be a rebound in oil and gas spending. You can see the beige bar, 2021 to 2022. There's a big jump. And I guess that's why we see some of the contracts being announced by Keppel and SAM. The other thing to note is also that the jump in the blue bar, which is the all capex. So this is all capex spent by companies like Shell, Total, Esso. We collate all of them and then we drew up this chart. But you can see that they are not responding to the high oil prices. So although the blue line, which is oil price, is almost back to the 2013 levels and 2012, but you notice the bars are not back there. So the all companies are definitely not responding because firstly, all the governments keep on saying go green, all is dirty. So number one, they're not going to spend because of there's a lot of the policies coming up from the government, and also number two, oil price was so volatile. It went negative, I guess, in year 2020. So that makes them very cautious. Even the shale companies are not spending because they spend so much money buying all the acreage, and then right now they just want to repay debt and return shareholders some returns. So as a result, this is going to be also a negative for inflation, because what it means is that without the supply response, there's a high chance that oil prices will continue to be elevated. Next slide. So I will move on to the stock pick. So this is our usual quarterly change in our model portfolio. We call it absolute 10 because it's supposed to be absolute return, and our top 10 best stocks that we cover. So these are stocks that we have actual coverage. So for the quarter, we were down 3.5. We were hurt by some of the REITs and also our mid-cap names. What we changed was we added SGX and we removed Asian Pay TV, I guess some would say finally. But why we added SGX is because we are turning very cautious and bearish for this quarter. So one way to hedge out, we can't buy REITs because with rising interest rates, they are also going to get impacted. So our thoughts was that to buy, I think we mentioned here before, was to buy volatility. So what we mean by this is that if there is a weak market, volatility tends to spike up. And because of that, the volatility, it will benefit SGX. It won't benefit SGX securities volume, which is the stock market volume, but it will benefit their derivatives volume, especially their fixed income and also the foreign currency derivatives. And the second reason, which Glenn also mentioned, will be their exposure to high interest rates. So high interest rates will also benefit them. Next slide. So this is just an illustration of the performance. So I guess if you're a fund manager now, you will be only talking about relative return. So there won't be much absolute return. You're talking about I guess who lose less, the winner. I guess that's one way. Of course, the fund managers won't tell you that that is what we call relative returns. Like who lose less is the winner, which is not a huge comfort, obviously. Next slide. Okay, I'll move on to Glenn for the banks.
Yeah, thanks, Paul. So for the banks, this is a comparison table between the three local banks. So of the three banks, we like DBS and OCBC the most. So I'll just start off with DBS first. We prefer DBS due to their high CASA ratio of 72%. You can see from the red box at the bottom, it's the highest amongst the 3 local banks. So it's higher than OCBC at 60.9 and UOB at 54.7%. So what does a high CASA ratio mean? So means that the positive impact from the rising interest rates will be felt most by DBS. And this would translate directly into their net interest margins, net interest income, and their PATMI. Furthermore, DBS's business momentum is also strong, and despite the economic uncertainties from the macroeconomic factors, such as slower growth, higher inflation, and supply chain disruptions, their loans and transaction pipelines are expected to be strong. Provisioning side, the management has said that the stress tests of vulnerable sectors and countries reveal no imminent areas of concern. So as such, we maintain a buy on DBS with an unchanged target price of $41.60. So moving on to OCBC, we prefer OCBC due to its upside of 20% to our target price of $14.22. And furthermore, OCBC is also currently still trading the cheapest amongst the 3 local banks. And OCBC will also be a beneficiary of the rising interest rates with a CASA ratio of 61%, 60.9 actually. So this is higher than UOB's CASA ratio of 55% and comparable to DBS's 72%. If you look at the OCBC's CET1 ratio, it's also the highest amongst the 3 local banks, higher than UOB at 13.1 and DBS at 14.2. So there's a potential for higher dividends from OCBC. And one more point to add is that OCBC's net interest margin is also the highest amongst the 3 local banks at 1.71%. So as such, we maintain a buy on OCBC with an unchanged target price of $14.22. So moving on to SGX. So SGX, we have put a chart here comparing the DDAV versus the VIX. So just a quick sort of explanation of what these two things mean. DDAV is the derivatives daily average volume, while VIX is the number derived from the prices of the options premium in the S&P 500 index. And this represents a good indicator of the expectation of market volatility. So by looking at the chart, we can see that the DDAV follows quite closely to the VIX. So when there's a spike in the VIX, which is the red line, we can see that there is also for the DDAV, the blue line will follow suit. So hence, assuming that there would be volatility in the market, we can expect that SGX would benefit from the increase in their derivatives volume, and this would directly impact their bottom line. So apart from the banks, SGX is also another beneficiary of the higher interest rates, and the treasury income is expected to recover with the rising interest rates, with the SGX's management mentioning that the low treasury income is only to remain for the following months, with an update expected later in the year. And as at full year 22, SGX reported a 13 billion Sing dollar float from collateral and 50 million Sing dollar of interest income. And this represents approximately 10% of their full year 22 operating profit. So we expect this to recover in the later part of FY 22, which is their financial year 23, as well as in financial year 24. So as such, we maintain a buy on SGX with an unchanged target price of $11.71. So that's all I have. I'll now hand it over to Darren.
Yeah, thanks, Glenn. So for the REITs, we have a buy call on Prime US REIT for their resilient portfolio. So in the previous quarter, they had 8 consecutive quarters of positive rental reversions, which show that their portfolio is quite resilient, and they have an occupancy of around 90%, which is stable. We also like Prime because of their tenant sector diversification, as you can see on the right, as 74% of their tenants are in established growth sectors. And because of their high hedging ratio, 86% of their interest is hedged to fixed rate, and about 50% of them expires in 2024, and the rest is after 2024. So we also like Prime because of their cheap valuations. Like I mentioned earlier, they are trading at about 0.6 times book, as compared to some of their Singapore listed peers, which is around 1 times or slightly under. and their high dividend of 12.5%. So with that, we have a buy call at 88 US with a target price of US 88 cents for prime US REIT. Yeah, so for you also have an accumulate call on Ascott Trust. This is because of the strong recovery in their portfolio RevPAR, and we expect this to continue going forward with the recovery in travel and all the pent-up demand. So another reason we also like Ascott is because they have quite a stable income base with a portion of it growth income, like 68% of them are on master leases or management contracts with minimum guaranteed income, and 32% of it is where you get your growth in portfolio RevPAR. We mainly like REITs who can reprice the rental income the fastest. So we believe Ascott is one of them, as the other REITs, like, let's say in industrial REITs, they only can reprice their rents when the lease expires. Another reason we like Ascott is because they have a track record of divesting their assets at a premium to their book value. And since 2018, they have about 400 million of divestment gains, and a quarter of it has been paid out. And so about 300 million of it is remaining in their books. They can pay out as distributions in the future or any acquisitions. It really depends on what they think. And with that, we have an accumulated rating on Ascott with a target price of $1.24, and Ascott has a DPU of 5.4%. So I'll hand over the time now to Terence.
Thanks, Darren. For Keppel Corporation, the main catalyst for them is the re-rating catalyst from the divestment of its O&M business and Asset Co. This is currently pending for some of their clearance and EGM approval by both Keppel Corp and Sam Marine shareholders. And this is obviously a very important re-rating catalyst for Keppel Corp. But what we're trying to show here is that even if the deal doesn't go through, and it's voted down for some reason, then Keppel O&M is still in a very healthy position. In fact, it's in a very good position. So if you look at the table on your left-hand side, its order book is currently, year-to-date 2022 order book is currently at $11.8 billion. This compares even favorably to its previous high of $5.1 billion in 2015. So it is a 7-year high, and they expect the most of these contracts in the order book is driven by the FPSO or the floating platform contracts, which historically, when you look at these FPSO contracts, they have contributed positively. They give about 5% net margin, and they contribute positively to the cash flows as well. So the order book here is quite resilient and strong. Having said that, we continue to watch the merger of the two entities. The pro forma EPS, earnings per share impact of the combined entity, will see an accretion of its EPS from 56 cents to 72.5 cents. So we continue to have a buy rating with a target price of 8.95 on Keppel. Next slide on BRC Asia. BRC Asia, for us, BRC Asia is a proxy, the best proxy for the construction sector. They have more than 2/3 of market share, about 67 to 70% of market share in the construction, in the reinforced steel sector. So they are building materials player. It's trading at 6 times of full year 22 PE, or 8.9%. FY22 dividend yield, which is quite healthy. And then for 9 months of 2022, their revenue and net profit already rose by 57%, almost 3 times on a year-on-year basis. So we have we maintain a buy rating on the company with a target price of $2.26. In my last counter for CDL is another one of our absolute 10. CDL is a prime beneficiary of the strong and resilient residential market in Singapore. So we believe the company or the real estate sector company with the highest number of land bank and launch pipeline will be able to take advantage of this boom sector in the property market. So if you look at the the launches already and upcoming launches for CDL. They launched Piccadilly Grand earlier in the year, first half, and it was 77%. So all the subsequent development properties that were launched also saw a healthy uptake, like Lentor Modern and Sky at Bedok all saw 75% to 80% take up rate, with the average PSF above 2,000 per square feet. So for CDL, the next launch is Copen Grand. They've already started soft launch for this EC at Tengah. This is expected to use 639 units. Newport Residences is the one to watch. This Newport Residences is the former Fuji Xerox Tower. They expect to launch this in the first half of 2023. The reason why we're watching this closely is because Newport Residences, they actually benefited from the CBD redevelopment scheme. So under the CBD redevelopment scheme, they actually allow them to pay a very small sum. CDL, they don't really want to share, but they just top up a small sum and then they get uplift in the plot ratio. So this to us, we think is pure profit, and they'll be able to get about 50% of margins from the launch. And then the rest of the units here, like 798 and 800, Upper Bukit Timah and Jalan Tembusu, in total will yield more than 2,000 units in the next 2 years. So the next tailwind for CDL in our next slide is the recovery in the travel sector. The hospitality sector continues to rebound strongly. This is driven by two main factors. The first is increased occupancy and rates in Europe and US. So RevPAR has already increased by 110% on a year-on-year basis. The second reason why the second benefit for the hospitality sector is that there's currently a strategic review for CDL's hospitality sector. So if you recall, earlier in the year, they actually recognized a substantial gain, about $500 million from the sale of Millennium Korea property. So they're actively looking at their MNC portfolio to see if there's any assets that is ripe for divestment, and then they will be able to realize these divestment gains in their portfolio and maybe distribute another special dividend, which they did in first half of 2022. So we maintain our buy rating driven on CDL, driven by two main factors. The first is the strong residential portfolio. The second is his hospitality portfolio, with a target price of $9.19. So that's all for me for CDL. I hand back the time to Paul.
Thanks, Terence. So I'll move on to the last few stocks. So we have the Monte, which is a buy. We like it because it's a consumer branded company, which most times they trade at high teens, or I guess right now maybe mid-teens, but it's still like right now probably 3-4 times PE based on the current price, and also 6% dividend yield. For those who are not very clear, so Del Monte, they sell mainly canned fruits, canned vegetables in the US, and also of course packed food, and also all kinds of pie, snacks and so forth in the US, and of course juices and so forth in Asia Pac, mainly Philippines. So one of the reasons that they have done well is, if you look at this chart, so this is the gross profit that between the US business and the Asia Pac. Asia Pac is predominantly Philippines. So since the new management came in, they've sold some of the old factories and they pivoted more into branded products. Whereas in the past, Del Monte US was mainly selling to private labels, like a contract manufacturer. Since then, you can see the earnings have jumped to last year. The US made about 400 million. Apologies. So we still think they can continue to grow in the US. In part because there's a transition, there's a switch right now. There's less dining outside and more home dining because of food inflation and shrinking household budgets. So and this is a consumer staple, which is more dependent on employment rather than household income. So we think it's also of a consumer defensive sector. The only one is to be, if you look at Asia Pac for FY23, we think there will be a drop in earnings because in Philippines, some of their product lines, especially canned fruits, is considered a discretionary item. So we expect a softer income coming out from Philippines. But one of the main growth drivers for them in Asia Pac is their export of fresh pineapples into China, which is growing, I think 40-50%. And these are really good margin business because there's no packaging. You just packet the fresh pineapple and you just ship it out to China. Next slide. The next is ComfortDelgro. Yeah, this is like my 20th time talking about it, but so we always prefer ComfortDelgro mainly for two reasons. Firstly, I think pre-pandemic the share price is right now the share price is at the lows. The share price is at the pandemic lows, circuit breaker lows. Secondly, compared to pre-pandemic, this stock was probably I think 270. And secondly, so we like it because there's the reopening theme. Especially since April, then you get more real traffic and better taxi numbers. But the other thing was also we wanted to buy into the cash flow. So we didn't want to just buy any reopening stock, like SIA, where they had to raise so much capital, so forth. But if you look at ComfortDelgro during the pandemic years of 2020 and 2021, they actually generated almost 1 billion of cash. So they came out of the pandemic with an even stronger balance sheet. That's why we wanted one of those unique reopening plays that wasn't really hurt that badly. Of course, earnings was down, but what happened was they cut their capital expenditure. And even when they come out pre-pandemic, their capex is still like 100 to 150 million below pre-pandemic levels. So we think the recovery will be starting from the third quarter, and the next 4 quarters you should see this reopening or recovery in earnings. And this should also help their dividend per share. But we haven't factored in whether it can return back to the peak of 10 cents, but we think there'll be a big jump to 7.5 cents. Next slide. So for HRNet, again, this is one of the familiar names. It's one of the largest recruitment agencies in Asia Pac with 700 recruiters. And almost half of their revenue actually comes from outside Singapore. Namely in Indonesia, Taiwan, China, and of course Malaysia. So these are some of the 4 key markets in Asia Pac. One of the strengths of the model is they can generate like 60 million profit on very little fixed asset. So this is like the ultimate capital-light business. Of course, they do need working capital when they do, because there are 2 parts to the business: the permanent recruitment, the usual headhunting, and flexible staffing. So flexible staffing, is like, for instance, maybe the MOH needed some staff to conduct vaccination and so forth. So they need the working capital to pay the salaries first. So, but again, even taking into account their working capital, they still have like net cash about 300 to 400 million, which is roughly like 40% of their market cap. They are spending, if you look at the SGX announcements, they are actually buying back shares almost every day. Next slide. I think this is my last 2. So for Singtel, we like it because we think there's going to be a recovery in mobile ARPU, which is basically pricing. Firstly, because of the reopening, and the roaming revenue will return, and roaming revenue is like 99% profit margin. Of course, before tax, you have to take out. Then there's also the competition has been more conducive. That's why you see the rebound in India, where it used to be 10 operators, then 3 operators, and then now maybe 2.5 operators, because the third operator is facing very tight financial conditions. There's also a restructuring team as they sell a bit of the some of Bharti and generated like 2 billion of returns. So in terms of the Optus, since probably someone's going to ask me about the Optus, so in our $3 target price that you see here, roughly, okay, let's give you some ballpark. $2 comes from their associates, which is Bharti, Telkomsel, Thailand, and so on. Around 80 cents, roughly 80 cents actually comes from Australia or Optus. So even if there is an impact on earnings, it doesn't really impact our sum of parts. It doesn't really impact our target price. Of course, if there is a fine, do note that this stock doesn't really react much to extraordinary income or losses. So when they generated 2 billion gain in Bharti, so the share price didn't really move much because the market will just look past this as one-off. So they do get these wild swings sometimes of extraordinary income. So even if there is a fine, of course, we're not sure how. We don't think the market will react that much. Of course, it's negative, right? But they really generated like 2 billion of gains, you know, from Bati, so that should help them in offset some of these Optus losses, if any. Yeah. Next one. So for this is our last topic. So for Venture Corp, which just as a reminder for everyone, this is a black box because we have no idea who the customers is. Sector also, we have no detailed description. We're not particularly sure where they're very strong in. Is everything outlook is just read the outlook statement, but we think there will be a strong second half for them. Mainly 3 reasons. The chart here that shows that Malaysia electronic exports has actually climbed up very strongly. Of course, this is a mix of semiconductors and so forth. But this is just like a proxy. This is comfort that electronic exports are up compared to what's happening in Korea and Taiwan. So one of the reasons why we think there's a rebound is, of course, there's a reopening. Last year, there was I think a 3-week kind of lockdown for them. Their factories to shut because of the pandemic. There's resourcing. So before the pandemic in 2019, because of the trade war and all the higher tariffs, when you export from China to US, a lot of US manufacturers were shifting out to Southeast Asia. So they were in the midst of getting this big boom, but of course, with the pandemic, everything all got dislocated. So Vietnam, like you can see, like Velotronics, they all have to go to Vietnam, and some also move into Malaysia. So there's this structural tailwind for all the Southeast Asian contract manufacturers. The other thing is just resupply. We think they mentioned that demand was strong, but there's a bit of supply constraints, but that should actually ease back. And they actually had to spend like almost 1 billion of inventory to kind of manage the supply chain. But we think the supply chain continues to improve based on at least the container freight rates. Of course, the last point is just that it's very weird to recommend a cyclical manufacturing company, especially when we just said that we could be heading to a US recession. But when we look at the types of products they produce, as much as we can, because it's still a black box, but you can see that most of the products they are not so exposed to consumer like computers or handphones. They are mainly, we think, a lot more counter-cyclical. So they won't be such cyclical products. So they are more into like 5G equipment, EV, cloud, medical. So these are less cyclical, and we think that should also benefit contract manufacturers and not get so affected if there's a sharp decline or recession out of the US. Next slide. So just some conclusions. We are cautious. Many of the macro headwinds, especially developed countries, I think we don't think Singapore will be heading to recession. Some of the sectors we like banks and capex related, like semiconductor equipment and oil and gas, vessel owners or operators. We think REITs are beginning to look attractive, but we think they need to have one more round of repricing. Then maybe the first quarter, like Darren said, maybe the first quarter will be a better entry point. Okay, I think we can take on the Q&A. Thanks, everyone. Yeah, sorry for those who have listened to this before, but no, that's what we typically do. Yeah. Okay, next slide. The community slide. Is it a community slide? Oh, okay. Yeah, thanks.
Yeah, so there are quite a number of questions on the REITs. I'll try to take them in chronological order. So the first one, ESR logos purchase of ESR Sakura DC, is it positive to the REITs? First of all, we do not have coverage of ESR logos, but for this acquisition, it is accretive to ESR. Because it is a pro forma, they are expected to have a 2.9% accretion to DPU. And will ESR logo issue rights for the purchase of this property? No, this is unlikely because they already mentioned that they already secured the funding for the acquisition.
Let me just add on something here. Sorry to interrupt. So yeah, sure. You will notice that they are buying a lot of these REITs are targeting Japan now. I think like one of the questions that was asked earlier is also because in Japan you can get low interest rates. So this is not counter to what Darren said about distribution, but Japan is where they can still do acquisition because interest rate is low, and then the rental yield, which is the yield, they can still get the spread. But of course, the sacrifice you make is just to the currency. I know you can have a low interest rate, but then you just have to worry about your currency depreciating. Yeah. Okay, sorry, Darren, continue.
So I think Paul's answered the next question about the REITs. If the jurisdiction that the REIT is operating in does not raise interest rates, then the problem affecting the REITs mentioned earlier will not occur. Yeah, for the REITs in Japan, so I think Paul already answered that. The next one, REITs. Can you explain the concept of negative carry? So for negative carry, it means that let's say you pay a 3%, okay, not say, let's say your cost of borrowing is 4%, and then the cap rate that you get is, let's say, 3%. So that means you are borrowing money at 4%, but the rental you get is only at 3%, which means you are actually losing money while doing while acquiring so-called. So this is called a negative carry. So this mainly.
Yeah, you can use a house. So maybe let's say buy a condo. Maybe just give everyone an example.
So you buy a condo, you pay, let's say, 3% for your interest, but then the rental, when you rent out, you only get like, let's say, 2%, 2.5%. Yeah, so you're actually losing money while doing this so-called it's something like leverage. You are borrowing money to get rental income, but actually the rental income you're getting is less than the interest that you pay. So you are losing money on that. Yeah, so that's negative carry. So does this apply to property stocks as well as CDL, CapitaLand? It does apply to REITs in general and those property counters who invest in investment property, but then not so much developers. I'm not sure if Paul or Terence got anything to add for this. Yeah, but then that's my thought. Okay, the next one is assets in the US will be affected badly because of the Fed's strong actions. REITs with assets in Australia may start to light up because the RBA is beginning to be more cautious, but reducing the size of their interest rate increase from 50 basis point to 25 basis point in the October meeting recently. Yeah, so this is actually in line with what we think also. If let's say the Fed also start to, we see signs that the Fed reduce the size of the interest rates increase and ultimately signs that it peaked and maybe even U-turn and start lowering the interest rate because maybe there is a recession next year, then that we think that might be a sign for us to re-enter the REITs. Okay, I think I'll answer one more REIT question before I hand over to the rest of my team. Would the above reasons impact the US REITs negatively and affect AIM's APAC REITs positively? It actually will affect AIM's APAC REIT the same as the other REITs as well because like for the carry, they are also affected, and rising interest rates, they are all also, AIM's APAC REIT is also affected similarly to the other REITs as well. So I don't see how this the above points mentioned earlier will affect them positively. Yeah, thanks. So I think I'll hand over to the rest of my team to answer some of the questions for now.
Thanks, Darren. I think I'll take on a few of the questions. There's one regarding CLI. It's asking, is CLI worth considering in the current environment? So yeah, because their core business, their core revenue, which is their real estate investment business, as well as their fee-related business, has actually done quite well. So their real estate investment business, it was growing. It grew based on their latest first half 22 results. It grew 44% year on year. And this was mainly on the back of reopening in most of their markets, except for China and Japan. But now with Japan reopening, we will see another boost, and we could see that an improvement. And also for their fee-related business, it also grew about 16% year on year. And this is expected to improve. So what we expect that their real estate and their lodging management business to continue to recover. And this is mainly on the back of the further easing of travel and mobility restrictions. However, they have a 10% FUM growth target, but this might be at risk given the current macroeconomic and geopolitical headwinds. The prolonged lockdowns also in China have also delayed planned transactions. So the immediate catalyst for CLI would be the pickup in travel, as well as the lifting of lockdowns in China. Okay, I think I have one more question. Let me check. It's regarding SGX. Yes, found it. So, does SGX always pay higher dividend when they have higher income? So, I went to do a quick check, and based on maybe I think the last 15 years or 10 or 12 years, their dividends have been quite stable. I mean, they have only increased it slightly. So there was a big dip, like almost 15 years ago, but they have been like steadily increasing their dividends. But it's like they will maintain it for about 4 to 5 years at the same level, and then they'll increase it by 1 or 2 cents. So if you can see what SGX has been doing recently, they have been acquiring quite aggressively. So I think that's where they are putting their excess capital into acquiring. Like they acquired BitFX and MaxTrader. So they are expanding this OTC FX pillar. So they are trying to grow it, and it has been proving results because you can see that this OTFX pillar has been growing and has been contributing quite a big chunk of their revenue as well as their income. So I don't think they always pay higher dividends when they have higher income. Okay, I think that is all. I will hand it back to the rest of my team. Thanks.
Yeah, I'll take over from here. Terence, how is UOL compared with CDL? They're actually pretty similar in terms of the portfolio that they have. But we prefer CDL mainly because of the land bank that they have. When we speak to the property development companies, what they are saying now is that the land costs have surged along with the rise in property prices. So they're also a lot more cautious with bidding for land bank. So because they don't know whether when they bid for the land bank, whether this can be absorbed by the market later on. So we think those who have a sizable land bank like CDL, because they have the largest land bank, then they will be able to benefit because they don't have to more than a company like say UOL, because they don't have to bid so aggressively for new land as compared to the others. If they need to replenish, then they need to bid higher. But otherwise, both are largely similar. We just prefer CDL. Yeah, hand back the time to the rest of my team.
Thanks. Let me just run through something. We pass it on to Zain. Paul, there are reports Europe is looking to stocking up coal for upcoming winter. Seems Golden Energy is one of the beneficiaries. What about Geo Energy? These two companies have different business model as Geo not moving. Will palm oil counters move with Europe entering winter soon? Okay, the main difference between Golden and Geo is that Golden Energy or Gear has also met coal, which is used for making of steel, and of course for thermal coal, their reserve is much higher than Geo. I think Geo's reserves from recollection, I don't have the exact number, maybe 2 to 3 years or 5 years, 2 to 3 years or more. But you know, when you're buying coal stocks, you're just renting these stocks. And of course, Golden Energy also has also a goal that they bought out of Australia. I think these are the two main business models, and they should all be moving together with coal price. So I'm not particularly sure why, but I think for Europe, the most meaningful time they will get the LNG supply, if I'm not mistaken, is only 2025. So or 2024, 2025. So Europe will still be very short of energy. Yeah. And for the next 2 to 3 years, and this should benefit coal, because even Germany said that they are restarting coal. Will palm oil counters move with Europe entering? I don't really see much of a. I can't recall of any seasonality for palm oil price. Of course, palm oil they don't really ship it during winter because it can solidify fast. So, but I don't see them burning much. The only thing is that might benefit them is because ethanol, the corn production is coming down, so that might benefit ethanol and maybe like benefit palm. But I don't really see the link for winter. Sorry, I'm not. Maybe there is, but that's for me. I don't really see it. Hi, any thoughts on Singtel share price in light of the recent hacks? Yeah, I think this can be an overhang, obviously, because people might just get worried what will be the fine and whether there's any knee-jerk reaction if there's a fine to the Optus. And even now, Dialog, I'm not sure how Dialog doesn't even deal with consumers. So Dialog is more a system integrator, system integrator like a NCS. But again, I'm not sure what is the fine, and then maybe that this might create some overhang for investors. But for us, fundamentally, the impact won't be that significant. I think, like we mentioned, they've got enough gains to offset that, and one-off gains from the party sale, and also Australia is probably like 1/3 of the value of our target price value. So when you take it off by 5-10%, it's of course it's impactful, but it's not that meaningful in that sense for us. Yeah, but I guess it will be an overhang because it's like it's an unknown, right? So any unknowns that's going to kind of cause some worry by investors. Paul, how much of the volume reduction is priced in for Propnex and Apex Realty? Our target price is higher than, I think our target price is 170 something. So it might have priced in most of it because it's quite a well-known phenomenon. But again, that is the level, but the flow won't be good, because in terms of flow of news, right? Because the next 2 quarters, I think earnings is going to be very weak. So even though the level might have reflected, but the flow, the news flow coming out would kind of put the stock under pressure. Because if you buy now, you're going to come up with like, you have to face at least 2 more quarters of weak earnings coming up. So that's going to be the headwind for them. So just to get back to the point, yeah, maybe the valuation might price in, but maybe the news flow, even if it priced in also, there's probably not much upside for now in the near term. Are your target price too aggressive? Observe from year past target prices, they have not reached, and the market always plunge and tank before reaching. Yeah, our target price, we try to be as objective as possible. So we don't, we are not like technical. We don't put like, oh, the target price should be 15-20% based on the current price and maybe keep low. So we just do, there are 2 types of valuation, as you know. If you do relative, then that one really just follow the trend. When the market down, then the relative is down, because the home, if all your peers drop, then you also end up dropping. So that one has a much more trend-like target price. The other one is to do DCF. So for us, we try to be as objective, but we try not to just look at the share price and then try to come close to it. But again, no, target price is a range. Yeah. But again, if you're in a bear market, the only target price is to call a seller. Yeah. Hi, Paul, what are your views on the UK mini budget? Not very familiar, but I guess UK is behaving like an emerging market now. Yeah, even Indonesia rupiah is performing better than the UK. So what that means is that if you have a budget deficit, you have to rely a lot on strangers. So you better treat the strangers well and not raise your fiscal deficit. Again, I don't have any good answer. I only know the headlines. Sorry, I don't really know much. But the curious thing is that maybe emerging markets look better now compared to all these developed countries. Will the hike in US dollar affect the bottom line sales? Del Monte has a huge unhedged debt funding. Okay, so for Del Monte, you're definitely right. Maybe I should have pointed out earlier, but the debt is the one that will keep investors, because they have like a 1.7 billion net debt. So that was the one I should have highlighted this, but this is the thing that makes investors a bit more uncomfortable. But again, for us, because they're growing and generating cash flow, so it will have have an impact. I just don't have the exact sensitivity now with me. I should have, but the net profit is about 100 million. So you can assume like a 10-15% impact if from interest rates, but not everything is unhedged. So they did do some rounds of refinancing, but I totally agree that the net debt is a big issue for them. But for us, when they're trading at 3-4 times PE, Of course, on the EV EBITDA, it will be higher. But for us, it was 3-4 times PE, and there's a recovery. So we were still comfortable with the debt, even though in a rising interest environment, I mean, rightfully, you shouldn't be touching these stocks. But for us, because the valuations are cheap, so we were willing to take a bet on this stock for us. Yeah. But should have highlighted earlier, yeah, the overhang for this stock is always the net debt. Yeah. So thanks for that. Okay, one last one before I hand it over to Zain. High-power asset-like company like HRNet tend to grow fast, and it appears to, but why is the share price not reflecting? I really don't. I'm not sure. I mean, all the mid-cap stocks are not doing well in general. I think for a mid-cap stock in Singapore to really capture investor interest, you really need to grow like 20-30% or more. I think if you don't hit those levels, I think you will probably, investors will just kind of derate you and not give you any light of day, I think in general. Yeah, I think if you don't have like a turbocharged growth in Singapore mid-cap, yeah, I think investors will just shy away from it. The appetite for that isn't really strong. Yeah. But for me, it's just that if you want to buy a stock and you want to sit on it and just let the economics ride out, right? The cash flow just come in, then probably this is the one of the stocks. Yeah. But in terms of whether the stock market will do a re-rating, so this time around it's going to be hard. I think most of the mid-cap stocks in Singapore are just not performing. Yeah, I hope that helps. Zain, yeah.
Okay, so I'll go through the TA questions. First one, Asian Pay TV. Okay, let me share my screen. Okay, so the first one, Asian Pay TV, currently it's in this downtrend channel for now. When we measure from using Fibonacci, when we measure from the March lows last year to the highs in January this year, I think it has tagged to this 61.8% retracement level around 106 for now. So then we're currently seeing support at 0.104 for in this channel support area. So that's the support that we can look to. I think another support is at maybe 103, 104, given that it was a previous resistance that we broke out from over here. As for the immediate resistance wise, I think it's likely to be at 0.111 to maybe 0.114 area over here, given that it's the downtrend channel resistance also. Yeah, and we also there's a lot of consolidation here before the price broke down further. So this might be a resistance level for Asian Pay TV. Yeah, I'll move on to ST Engineering. ST Engineering has been, the selling has been quite fierce recently. Currently, I think when we measure from the COVID lows to the highs for this stock, I think it's nearing the 50% retracement level at around 330. So that could be immediate support for ST Engineering. We broke the swing low support here at 350, around 350 over here, and then also at 340 over here. If 330 cannot hold, right, I think we might there's a chance that it could hit to about 320, which is this swing low in November 2020, and lower than that is about 310. Then which is a 61.8% retracement level for ST Engineering. Then I think for immediate resistance wise, likely to be at 350 region over here. The breakdown of the swing low over here where the stock kind of sideways for a while before selling off. Okay, then moving on to sets. From the overall picture, I think even before the news, the acquisition news, it kind of already broke down this key uptrend support line. Then after that, we sold off aggressively. For now, I think the immediate resistance is at 307 to about 315 this region. Then the immediate support quite obviously that's holding it after the news is about 295 to 296 area. But if we go if this support level is broken, then I think the next one should be at around 260 to maybe 280 levels, which was like support in May to September 2020, back when the COVID period over that time. So that's for sets. Okay, I'll move on to Parkway Life. Okay, Parkway Life, I think from a technical point, doesn't look very good. Given that it broke down on this neckline support over here, and then there's a possible head and shoulders, bearish head and shoulders that's forming. If we use from a technical point, if we measure, it's about the neckline is about maybe 70 cents, and we project downwards, maybe it will hit like 370 or 380. Currently, I think then when we use a Fibonacci retracement from the 2020 March lows to the highs, the immediate support might be at a 38.2% retracement near $4, and that's also a psychological level. I think previously there was some resistance over here near $4, then before the stock went higher, so that might be an immediate support for Parkway Life. Then if we get lower, then maybe it's 50% level at near 370. Then if below 370, maybe it's like 360, because there's quite a bunch of swing lows over here in November to December 2020. And for the immediate resistance, I think for now it will be this 435 level over here that we bounce to, but continue sold below. Above that is likely maybe this 440 swing low, or even this 450 point that we broke down from. Okay, moving to the three banks. For DBS currently still looking good in an uptrend channel. The resistance has proved to be quite strong, is around 33.70. So every time we hit over here, the share price kind of like headed lower. Then I think for immediate support wise, probably at near if we follow the trend channel, it's probably maybe 32.60, 32.70 area. There was a swing low support over here at around 32.40. That's another point to look out for DBS. Then moving on to UOB. UOB doesn't look as strong. It's quite an obvious breakdown of this consolidating wedge. Then after it broke down, we retest, then there was a rejection candle over here. So we then now continue to head down lower again. So for the immediate resistance around 2670 to 2690 zone over here. I think immediate support is likely around the $26 swing over here to 2630 over here. So 2630 last time it was a previous resistance. So it might become a potential support over here for UOB. And for OCBC, also a bit similar, given we broke down a swing low over here at 1190, then we tested, become a resistance over here. So 1190 to about $12, this zone is the immediate resistance. Then for immediate support wise, probably I think it could range from maybe 1150 to 1170 over here. So 1170 is the recent swing low that we bounced from. We also have a gap around 1158 to 1166 yet to be filled. We might come back to fill this gap. And then the 61.8% level is 1150. Yeah, so and then there was a couple of swing highs over here that we broke out from. So that around 1160 is that could become a support now. So 1150 to 1170 is the possible support zone to watch out for OCBC. Okay, then SPH. And for SPH REIT is in this downtrend channel for now. Okay, then when we look from Fibonacci from the COVID lows in March 2020 to the high over here. Currently, I think we are near the 38.2% retracement level, around 85.5 cents. So, and then we have this channel support over here that kind of is like the stock kind of bounced up a little bit from here. So that will be the immediate support over here. I think for immediate resistance, probably this key support area around 91 cents to 92, 93 cents zone that we broke down from over here. That will become a resistance for SPH REIT. Okay, Jardine CNC. For Jardine CNC is been on a nice uptrend for now. I think for immediate resistance wise, probably this 3580 to 3680 zone. For now, temporarily we saw some selling over here. Then if we go higher, it's probably this trend line resistance that will act as resistances, maybe about 3770 already. As for the immediate support, I think probably at 3160 to 3350 area. Given that this was a resistance that we broke out from, and then there's a swing low support over here as well. So overall, the trend is still looking good for Jardine CNC. And then I move on to Chip Eng Sing. Okay, for Chip Eng Sing, the uptrend is still intact. A series of higher highs and higher lows being formed over here. Okay, then last week we also managed to break out of this the downtrend resistance line over here, and then also this recent swing high resistance over here about 71 to 72 cents area. I think for now the resistance is at 73 to 75 cent zone, the previous swing high made over here. Then if we go higher than 75 cents, I think there's a chance that it might go to 78 cents area, which was looking back at the chart last time, I think 2018, 78 cents over here, we saw some, it was a swing high resistance for Chip Eng Sing. As for the immediate support wise will probably be this 71 to 72 cents level that we broke out of. Then if somehow it hits lower, then probably a stronger one will be at 67 to 68 cents. The previous resistance now turns support area. Okay, I think I'll answer three more questions before I hand over to my colleagues again. Okay, for Yang Zijiang, short-term uptrend still intact, forming a series of higher highs over here. Then we saw some higher lows being formed over here as well. As for the immediate resistance, likely to be at 120 to 127, this area over here. Then I think for immediate support is likely to be at 108 to 111, this zone. So previously when the stock pulled back over here, it broke down this zone, and then we went back up over here again. Then the stock continued to went higher. So if it come back to fill this gap at 110 to 113 area, so this might be a support area for Yang Zijiang. Then if we use the Fibo retracement tool, 108 to 110, right, is the 50 and 61.8% Fibonacci retracement levels. So that's probably some support over here. Yeah. Okay, Silver Lake. Okay, I think Silver Lake for now, probably maybe some continue to consolidate. I think last time around the 32 cents to 34 cents zone was the previous resistance over here. Then currently likely to become a support for now. So probably, I think that since the stock has come back to over this area, it's likely to consolidate for a while. Then you think immediate resistance wise, probably at 37 cents to 39 cents area. So it's a zone of support over here. Then I think then we broke down a bit with this downtrend channel in place. So that will become a resistance for Silver Lake. Then last page, okay, already answered. Okay, I'll pass back my time to my colleagues.
Yeah, thanks. Anyway, for the Golden Energy, sorry, I missed this announcement. I mean, they mentioned that the owners might buy the company. Yeah, sorry, because this came out at 12 something, so I didn't see the announcement. But just to get back to the question on Golden Energy, I think if you just check the announcement, it was out about 12:15. The company said that there's a discussion of a possible acquisition of the company. Yeah, so sorry, I didn't see this announcement for Golden Energy. So let me just run through a few more before we hand it back to Zane. What are your views on Parkway REITs generally? Anything to add, Darren? I think the strength of Parkway REIT. Yeah, sorry, you go ahead.
Yeah, Parkway has a rather resilient portfolio, but I mean because of that, then they're also trading at really high book value. Like I mean just now in the slides I saw the book value. I can't really remember off the top of my head what it is. And then they're also trading about 3.5% yield. So if you ask me, I wouldn't think I would want to invest Parkway, because if the bond is really paying 3% or fixed deposit, for example, paying 3%, then why would I want to take that additional risk and invest in a REIT that pays about 3.5% yield? Yeah, so that's what I think. Don't know whether Paul has anything to add for that.
Yeah. And I think like what the other attendee asked, because it's yen. Yeah, I mean you can get. I mean maybe if you want to buy something that's yen like, then maybe it looks attractive in yen terms, I guess, on an unhedged basis. Yeah. So
Yeah,
from
they
that
did
sense,
acquire,
yeah,
some nursing homes recently in Japan.
yeah. So I guess if you view this as a yen asset, then it looks attractive in that sense, but I don't. I mean, for us, we're all Singapore based, so I don't think I want to take that 3% yield. Yeah.
Yep. And then another question is, the quick scan of the REIT valuation seem to indicate a lot of the REITs we have to trade below their NAV to reach reasonable valuation. Is this correct? Yeah, right now a lot of them are trading around 1x, but then if there's another sell down, then definitely they'll reprice and then they'll trade under their NAVs. So we do think some of the local REITs will start to move towards below their NAV in the coming in the near term. Yeah.
Yeah. Because there's no like magic rule why they can't trade. Like even Keppel DC can trade so much higher than the book value, which we are not sure why. But anyway, yeah. So it depends how investors view this. I mean, most investors might view S-REITs like a income instrument, then they will just price it based on the amount of yield they get. Like property developers can also trade at 50% price to book, even though they got investment properties inside. So there's always that possibility. Yeah, it doesn't mean that NAV is like a golden rule they should not go below. How about, can you repeat the point that S-REITs may get hit again? I missed that point. What did I say? I can't. Okay. Anyway, what we're just trying to say is that the two pressure points. Sorry if I'm not answering the question, but the two pressure points for REITs is of course rising interest rates. So you can assume 200 basis points or 2 percentage points. Then if they need to hedge their interest, because they always like to say they hedge, right? So you can't say you don't hedge now. You could add another 200 basis points more, because the banks are not going to let you hedge so cheap like in the past. They're going to charge you more. So the impact can be very high. Although most of them, the REITs, the REITs say that they have it hedged, but most of them hedge maybe 2 years, 3 years. So what we're just trying to say is that there is very little chance for the REITs to grow the DPU. They can still grow this year, maybe whatever remaining the 2 quarters, but as the hedges start to unwind, right, you see this big spike in interest expense, then they very low chance for them to grow. So then you end up becoming like a bond. Yeah. I'm not sure if that was the point, but sorry if I'm not answering the question. Yeah. But what is the impact on the market, especially UMS and AEM with the latest tax restrictions imposed by the US? Probably indirect. AEM sell mainly AEM sell mainly to Intel, so most of them are onshoring to the US, so the impact will be less. But AEM also mentioned they have a new memory customer, but I think they mentioned that was a Korean customer, so I don't think they'll be impacted. UMS is mainly applied materials. There might be some indirect impact, but the thing is whether they're gonna, how much they're gonna enforce. So there could be probably a larger impact on UMS because of applied materials, but again, we really do not know. I'm not sure. I need to go to apply and see how much is China sales and so forth. So sorry, I don't have a very detailed answer for you. Yeah. Your thoughts on Genting reopening and bid for Macau gaming license? Yeah, just for information, there are 6 Macau operators in Macau. There are 6 casino operators in Macau. Used to be a 20-year license. By end of this year, they will announce who are the winners. Genting is bidding it through Genting Malaysia, I believe. So, but I don't rate the chance. I don't see them. What makes Genting so special? They can win. The 6 operators now already. Firstly, they're not going to lose this. This is like a biggest gaming market, right? I think 5-6 times bigger than Las Vegas. Number 2, these 6 operators have been there for the last 20 years. You can imagine the amount of relationships they built. And they also spend billions into infrastructure. So they're not going to let this go easily. It's like, I don't know, they did bite on this thing. They're not going to let it go so easily. So I don't see what advantage Genting has. Yeah, in terms of winning this bid. Again, this is outsider's point of view. Nothing, no insight, no other better thought, better views. Yeah. Thanks. I think Zain, just go through the last few and then we can end it.
Okay, so I'll go through the last few TA questions. For venture, for venture, I think starting to possibly turn bearish for now. Given that we, after the strong run up, then we kind of consolidated at the highest area. Then we started to move lower, given that this $17.50 level from support kind of became a resistance over here. And then we started to form a lower highs over here as well, and as well as some lower lows. Possibly there's this bearish flag that's currently forming that we broke down off. So I think the immediate resistance wise is around $17 upwards to about $17.50 area. As for the immediate support, I think is this swing low at around $16 to $16.30 area. If we go lower than that, then maybe you'll hit a 50% Fibonacci level around around the 1530 level, which was a swing low here back in March. That's 1560, and then there was a previous resistance that we broke out from over here around the 1510 level as well. Okay, then for Wilmar, I think it's bearish, given there was this important neckline at around 383 to 393 level over here. And then we broke down off, then there's this possible bearish head and shoulder formation. So for now, I think the immediate support probably is this swing low 370, this cluster of swing lows over here at around the 350 area. So this also coincides with the 61.8% Fibonacci level, 355. So that's for the immediate support. Then immediate resistance is this 383 to 393 neckline that we broke off. For Singtel, looks like for the short-term uptrend, looks like it's invalidated. We broke down the key support over here at around 263, 264. Then we tagged onto this this key trend line that's been supporting it since late November 2020. So we need to see whether this, for now it looks like it's broken down, but we need to see whether it holds by moving back up within maybe next 3 days. Then that will confirm the long-term uptrend is still intact. If not, the next support maybe at this 242 to 243 swing low level, or this next swing low level around 237 area. Then for immediate resistance wise, it will probably be this support zone that we broke down off. So that will be around 254 to 256. Then going higher than that is around 260 to 263 level. Okay, for Genting, currently in this uptrend channel for now, so still looking good. So the immediate resistance likely to be at 81 cents to 83.5 cents, which has tested multiple times over here. Then immediate support, if you go back down to the lower side of the channel, is around the 77 cent zone over here. And then the swing low over here was around 75.5 cents area for Genting. And for CSPC pharmaceutical, I think currently resisted by this downtrend line over here. As for the key support is this neckline 680 to 720 that's holding the stock for now. So for the immediate resistance, it's likely to be this trend line resistance at around near the $8 to $8.70 zone over here. And for immediate support will be this neckline 680 to 720 region. Then if we break down on this neckline, we might actually go down lower to maybe near 560 to $6 back to this swing low region. Yeah. And the last tier question will be Singtel. Singtel still nicely trading in this uptrend channel for now. Then I think the immediate resistance wise probably this previous high level at 163 to 168, 169 level over here. Then for the immediate resistance, immediate support wise around 156 to 158. These swing lows that was formed, and then also this channel support over here as well. So that's all from me. Yeah. Paul, do you have any closing remarks?
Yeah, okay. Correct. There's one last one about Maybank Mark Genting perhaps potential spike in value. Okay, not sure how much is that value. How are you going to value Torex? But anyway, this question is about Torex. So for those who don't know, I think this has been almost 10 years. It comes and fits and bursts. The news about Torex for Genting Berhad, which got torpedoed into getting this Torex. I mean, like a casino running pharmaceutical. But anyway, I mean, if you just go through the media, they didn't really, the test wasn't very conclusive because there was no, when they compare it to placebo, their placebo means when they compare to patients that didn't take the medicine, they couldn't really differentiate the results between those who took it and those who didn't take the medicine. So I really no idea. I mean, but based on what what is out there in the news, that may not even seem to have worked now because they couldn't find a meaningful impact between those who took placebo. It means those who drank water and those who didn't and took the medicine. There wasn't not much of a difference of the whether it's effective. Again, I'm not sure, but this is all I can. This is what the media has said. So just take note of the risk involved. Yeah. And then with that, sorry, I'm not an expert on this, but with that, I'd like to thank everyone for your time, especially your questions. And some questions we really have, if we can't answer, we don't have the expertise to answer. Yeah, so sorry for that. Yeah, but with that, I'd like to thank everyone for your time and wish everyone have a good week and good and safe week ahead. Thank you everybody for taking the time and spending it with us. Thanks.